Imagine you're in the process of refinancing or switching your mortgage over from one lender to the next. You found a fantastic rate and you're about to close, and all of a sudden you're getting hit with a $9,000 penalty. This week I want to take an opportunity to explain to our clients or viewers how to avoid this costly mistake that happens more often than we'd like to think, especially if you're refinancing or switching your mortgage. You're not going to want to miss this. Once again, thanks for stopping by. If you have not yet subscribed, please hit that subscribe button, hit that notification bell while you're down there so you can stay up to date with all the mortgage news, everything happening in the mortgage marketplace. Don't forget to leave your thoughts, questions, and concerns in the comments section below. Like and share the video. Let's get right into it. So during the process of refinancing or switching your mortgage from one lender to another, maybe you secured a better rate, maybe a life event happened, you have to switch lenders, you're refinancing, you restructure your mortgage. There's multiple reasons why you may be doing this. And ultimately, whenever making that switch from one lender to the next, there's a few things that you should be paying close attention to in order to avoid costly mistakes. Now, before we get into the advice, it's important to understand what and who is responsible for what part of the mortgage transaction. So to make it very simple, if you're using a mortgage broker or you're dealing with your rep at your particular lender, your financial institution, well, their job is to basically provide the advice, go through your options and make sure you're selecting the best rate, terms, and options in that mortgage. Whether using a broker or a frontline rep, the process is basically to collect all the documentation to submit to the lender of your choice and basically secure the financing. At that point, the lender takes over once the broker is complete and they basically underwrite the deal, they verify the documentation, and that lender prepares the funds for that mortgage to be dispersed. That usually happens either with a bank's internal closing system, a third-party provider, or a lawyer. So basically, just to put it in a nutshell, the lawyer can't fight for a better rate with the lender, just like the broker or frontline rep cannot do the closing transaction on a mortgage. So now that we got that out of the way, what's happening right now is a lot of situations that we're hearing, especially as banks are tightening up their criteria and they're wanting to keep more of their existing business since, as we all know, right now there's not a lot of new transactions happening, so banks are trying their best to keep their existing clients at their particular financial institutions. Now, when going through this process, there's a lot of things that you need to understand. Obviously, who's responsible for what, as we discussed. So when you're going through that refinance or you're going through that switch from lender A to lender B, generally you need to notify your lender, the existing lender that you're with, that if you're approaching maturity and you're getting pretty close to it, that you're going to need to renew into an open mortgage. Just in the event that your mortgage and refinance or switch transfer does not close on the specific date, because that could trigger a massive penalty. We've heard stories of clients that have gone through the refinance process, and then at the end, when they got to the lawyer's office or to the internal third-party provider, they missed the closing date, they extended, and ultimately what ended up happening is they had to request a new discharge statement from that lender. And what happens is if that lender auto-renews you into a closed term, may there be a 6-month closed, there could be a significant penalty. And we've heard some clients about $9,000 to $10,000 if they fail to meet that guideline. So there's a lot of things to really unpack there. Generally, as long as you're closing on the specific date that your mortgage is maturing, then there shouldn't be any issues. Most financial institutions, when requesting a discharge statement to pay out that existing mortgage, what ends up happening is there's a buffer, there's a window in there, and there's a specific date. And if it doesn't meet that date or you don't close on that date, not really a big concern. There might be a small per diem interest charge for an overlap. But there are certain lenders in the marketplace that auto-renew their clients if you don't notify them into a 6-month close, basically negating any of the benefits that you may have had to switch. And on top of that, if you're going into a shorter term locked-in product, depending on your financial institution, the rate can be 2-3% higher than maybe your existing rate or that new contract rate that you secured with your broker. So you have to pay very close attention to that. Now, some advice would be obviously notify your lender on action once all the documentation is there, that if you're going to get close to that closing, hey, renew into an open product. Oftentimes, if you're refinancing ahead of that maturity date, then the penalty will just incur anyway. The closer you align it to that particular date where that mortgage matures, then you avoid penalties. But that comes with a risk, because once again, if your particular bank is one of those institutions that locks you in, then you might be facing some significant headwinds and obviously a lot of headaches and nightmares to try to rectify all that. Because most of the banks, once you are locked in, you have to write out that term unless there's extreme circumstances. So try to avoid making sure your maturity date is aligned. Usually what we do here is obviously put it a couple of days before. There might be a small interest charge for a couple of days. That's better than getting hit with a $9,000 to $10,000 penalty. And once again, understanding when your mortgage matures. Is it on a weekend? Is it on a long weekend? Is it on a holiday? We've heard clients, for example, that happened that their mortgage maturity was on the Good Friday. And ultimately, what ended up happening with some of these scenarios that we hear of is that they had missed that window. The third-party provider failed to close on that date, needed to request a new discharge statement, mortgage got locked in, $9,000 penalty gets triggered. Now you have to backlog everything, and all the banks and lenders and stuff like that are pointing fingers at who did what. So avoid those mistakes. Make sure your mortgage is renewed into an open product. And if your lawyer or third-party provider from your lender in your print is telling you to renew that lender into an open product, I would suggest that you do it. And once again, these are things that sometimes get overlooked, but it's super important because it can basically kibosh or cancel the whole benefit of having to switch over from lender A to lender B. Now, once again, if you know someone that is in this situation, they're looking to refinance or switch from lender A to lender B, you may want to share this video with them so that they don't get caught up in that trap. If you have questions about your mortgage or refinancing or switching, please feel free to reach out to our team here at InTouch Mortgage Solutions, but make sure you're subscribed and we'll see you all next week.